Hi, I'm Mark Heyhoe. I'm an advisor at Fox-Davies Capital. I'm sorry to welcome you to the Mind the Money Online Connect keynote panel on potash. I'm joined today by Seamus Cornelius, the Executive Chairman of Danakali, and we are Achim Strauss, CEO of Kanga Potash. Welcome, gentlemen.
Hello.
Just for people who are not particularly aware of the space, I mean, what is potash and why is it important? I mean, Seamus, do you want to just kick off with that?
Yeah, absolutely. I mean, potash is potassium fertilizer. The two main types are potassium chloride and potassium sulfate. And it's important because potassium is one of the critical things that plants need to grow. The top three things for plants, other than sunlight and soil and water, are NPK, nitrogen, phosphate, and K is potassium. That's why it's important. Okay.
I mean, in terms of fertilizers, we're talking about it's used to produce food, obviously. What's the sort of the macro picture for fertilizer use and for food demand? I mean, it's pretty easy to understand the market dynamics of that.
Is that to me, Mark?
Yeah, if you don't mind. Yes, Seamus, sorry.
Absolutely. Well, the macro picture is really straightforward. More people means more food. And if you couple that together with economic growth, so more people moving up and having greater spending power, then that means more of particular types of food. You can put in other macro trends where fruits and vegetables and nuts and berries are becoming much more popular. You can look at vegetarianism, you can look at veganism and all the other variations on that. All of those things are plant-based, all of those things require fertilizer, all of those things, that means they need potassium.
Yeah, perfect. I mean, the thing about potassium and potash is that it's geographically used everywhere in all sorts of agriculture, but actually in terms of location where it's formed and where we actually get it, it's only a few. It's quite rare geologically. I mean, all of it was formed, in these evaporated from seawater in these basins, usually in an arid climate. As the salinity of these basins changes, you get different salts precipitate out. And as I said before, it's used in over 180 different countries, but only 12 actual countries actually produce it. Do you want to? I mean, I'll talk to maybe Achim first on different types of potash. I mean, Achim, you're going to be producing a myriad of potash, MOP. Do you want to just tell people about MOP, and then Seamus, you can talk about SOP, which I know you're going to be producing.
Yeah, thanks, Mark. So yeah, our project is located in the Republic of Congo. The Congo itself is well known for its carnallite resource. There's extensive Congolese basin, and basically, if you mirror this with South America, I mean, in Brazil and other places, there are basically similar types of carnallite resources. We are basically focused on carnallite that we have explored over the last few years, and we are exploring carnallite, which is basically done by solution mining. I think it's well known most of the MOP operation are based on conventional mining, some of natural brines, and we apply solution mining. And maybe Seamus would like to add a few words on his project in the other part of Africa.
Yeah, that's for sure, Achim. That's fine. Yeah, so we're going to produce SOP, which is sulfate of potash. The formula for that is K2SO4. The main difference with KCl, which is MOP, is obviously there's no Cl, so there's no chloride in SOP, and it's got the sulfate in it. So sulfur is also a nutrient, although it's a micronutrient rather than one of the major ones like the NPK that I mentioned earlier. We'll be doing open cut mining. Our deposit is, as you said at the beginning, Mark, it's an evaporate deposit, but it's in terms of geological time, it's relatively young. So it's still very close to the surface. It's only 16 meters below the surface. Our deposit's in the Danakil Basin in Eritrea, but it also, the basin itself covers Ethiopia as well. So we'll be doing straightforward open cut surface mining. It's a very large deposit. And the thing about K2SO4 or potassium sulfate is that because it doesn't have chloride and because it has the sulfur on top of the potassium, it's good for particular types of plants, usually fruits, nuts, berries, coffee, tea, potatoes. Those types of things are what require our type of potash as opposed to the MOP. The MOP has very wide use, don't get me wrong there, but our specific use is on those particular products I just mentioned.
Yeah, I mean, generally when people talk about potash and you look at any price indication, anything like that, we're generally talking about MOP, which is the bulk of the market. But I said SOP is a premium product, no chloride in there. I mean, for full disclosure, I was the CEO of Harvest Minerals in Brazil, so I've got some background in sort of fertilizers. But what's interesting about your deposit is traditionally all these deep, silverite projects are quite deep, whereas you're quite shallow. Now, talking to Achim, you're producing the MOP, which is, when people generally talk about potash, that's what we're talking about. Can you just describe how, if people who are not familiar with the space, about how you're going to extract your products? Because these are the two.
Yes.
Yeah, go on, Achim.
So, well, maybe I just give a little bit of background. I've been working in the Republic of Congo since '98. I've been also involved in another MOP project, and where actually we identified carnallite seams of a thickness of 40 to 50 meters, and that was basically up to 2011. This was the Mango Potash project, and at that time we thought, 40, 50 meters of carnallite seams are actually quite huge. When I joined Airbed Funds, this is actually our major shareholder for Kanga Potash, we actually embarked on a quite a different mission. We looked at some offshore carnallite seams that seemed to be identified, and then we basically moved back from offshore exploration to onshore to see whether these thick seams that were identified offshore could be identified and developed onshore. Of course, it's much more economic to do onshore drilling than offshore drilling, and we actually discovered and seemed in excess of 210 meters of mineable, exploitable carnallite. We don't apply conventional mining. This would be not applicable and advantageous for our project. We do solution mining. This is basically, we use a solvent, basically seawater. We drill wells between, and the seams are between 350 and 1,000 meters. We inject water, dissolve the different the minerals, basically carnallite, which comes along with also some table salt, and then extract this and then process this into MOP. It's a very well-developed methodology. It's applied in many other MOP operations worldwide, and it's proven technology. And basically, it's more like a copy of the Dead Sea Works in Arab potash operation in the Dead Sea, where basically they generate the carnallite crystal from evaporation pans. We do this, we crystallize our KCl through evaporation processes, crystallization and decomposition processes.
That's good, thanks, Achim. I mean, you're both potash development companies. I mean, the reason I asked you, and I'm very grateful you both agreed to come along, is you've got slightly different projects in terms of how you mine it, slightly different products, but you're both potash. But in terms of, as bulk commodities, it often comes down to logistics. I mean, Seamus, you want to just kick into where I said before, it was 180 countries use potash, but only 12 produce it. Where's your market? What's the logistic solution for you? And I'll ask Achim the same.
Yeah, you're right, Mark. I mean, for us, and for any bulk or semi-bulk commodity, the closer you are to your customer, the better it is. That's generally speaking a broad rule of thumb, that you want to be close, because it cuts out some of that logistics and non-profit costs that you have to incur. So for us, our customers, fortunately, are going to be in the Middle East, Southern Europe, over to India and Africa. And we're right up on the Red Sea, on the African side of the Red Sea. That's where Eritrea is. So for us, we're going to focus initially on those, the most closely located customers. There's Ethiopia across the border. There's Tanzania to the south, where they make a lot of coffee and some tea. That's an SOP product. But then all through the Middle East and up into Southern Europe for fruits, nuts, berries, high-value veggies and things, all the way over to India. That's our primary target. That's in terms of the geographic location of where we want to send our product. As we produce more and more, we'll send it further afield. But that's the starting point.
Yeah, perfect. Achim, you're on the other side. of Africa?
Yeah, basically, we are on the other side of where Seamus project is located. We are basically just a few kilometers up the coast of the economic hub of Port Noir. They do have a deep sea harbor. However, we opted to develop our own transshipment jetty. Our basically ex-works cost is equal to our FOB cost because we don't need to ship our product as many other producers from landlocked locations to the port of export. So we are right at the coast, and our target market is of course Brazil for granular MOP. It's probably the fastest and one of the largest growing markets for MOP, and the sailing distance for us is also very big advantage in light of current logistics costs, transport costs, etc. So we have 8 days direct sailing to South America. We could also, of course, market to other African countries like South Africa and where other NPK distribution hubs are located.
Yeah, perfect. I mean, it's same as any bulk commodity. It's all about logistics in the end. There are, challenges. You design a mine plan, you get it all working, get the person sorted, but then it comes down to you got to sell the product. Can we just talk now, sort of a macro picture really about the market? What's the outlook for potash demand, and what are sort of the key drivers going forward? I mean, Seamus, do you want to just touch on that?
Yeah, absolutely. I mean, anyone who's been watching the space, I mean, the whole fertilizer space lately, and also, but in particular the potash space, will be very happy. The prices are going up. They have been down for quite a while, probably 7 or 8 years of relatively low prices. But in the last year, and particularly the last 6 months, the potash prices have gone up. And of course, all the forecasters have raised their forecast along with the fact that the price has gone up. So, we had some very reputable forecasts 18 months ago, and then we just got some for a very particular reason that we're working on now. And the average increase for our forecasted markets was 30% in 18 months. So, and we got, 20 years forward looking. So look, it looks rosy. It looks a lot better than it has been. I don't think those forecasts are reaching the high point yet, because when you look at MOP in particular, SOP is sort of a derivative of the MOP price, because quite a lot of SOP in the world is produced by a chemical process of converting MOP. So that's one of the drivers for the SOP price. So when MOP goes up, SOP has to go up in lockstep just because of the nature of the supply side today. So SOP is going up. MOP has gone up tremendously. And I think there's some structural changes going on there, which Achim is, no doubt better off than me to talk about. But I think in summary, the way I look at it is a lot of the big producers over the last 10 years have been managing the supply side quite carefully. And they've usually been doing that by shutting down mines. No one would ever say that they're a cartel, but they certainly have many behaviors that look like cartel.
Next question.
Yeah. So, but, I think what's happened is they've probably reached the end of their ability to do that. Now they seem to be shutting the higher cost operations, and starting to talk about opening them again. So I think it looks pretty rosy for the potash space, generally speaking, at the moment. And I think the other final thing I'd say is all of the analysts overestimate. They do a supply demand, forward-looking curve. They always overestimate the supply side, and it's because, quite rightly, I suppose, they don't have any filter on project likelihood of getting into production. So if someone's out there promoting a X million tons a year project, when they do their supply demand curve, they'll just assume that's coming in at the time it's meant to come in, and it obviously won't, in most cases. So that's why I think it looks pretty good at the moment.
Yeah, I mean, we did have. Yeah, go on, Achim.
Yeah, I tend to agree. I mean, I think we all don't have the crystal ball to look into. I mean, it's very nice to see MOP prices currently in Brazil at $700 plus minus. But my view is basically, I think we don't know where the race is going to. We saw a spike of MOP prices in late 2008 as well. I think it hit over $1,000 for a couple of months. In any event, I think what is important for newcomers or producers like us, I mean, we need to have a very competitive cost basis in the event that there's a downturn, that prices go down again. I mean, we are producing at whatever module size. We've done a range of scenarios from 400,000 tons to 2.4 million tons that our resource can accommodate. We will be producing way below $100. So if the prices are sustained at current levels, fine. If they go up, even better. But we're also happy with prices that we assumed during our DFS study level.
Yeah, I mean, I think there's a couple of points you both touched on there, which is sort of reflects on what's happening in the market currently. I mean, we had a big increase in demand, well, a drop in 2019, and a big increase last year from about 63 million tons to 69 million tons. That's a huge increase year on year. And, these, producers haven't got the ability to turn that level of production on quickly. We drove down their inventories, which, get the price up. But then this year, we've got a shortage of inventory as well, which has caused a spike in the price. And I can't see, there's still going to be a structural deficit this year without replenishing that inventories, both as a supplier and at the ports. We look at Chinese and Indian inventories at port are all down 35% year on year. So we can see these prices being, definitely sustainable over the short term. I mean, can we just talk a bit more about the supply dynamics? Yeah, I said, 69 million tons, up to 71 million this year. If you want to, I can talk about it really about the marketing of potash, particularly, 85% of the actual market is controlled by about 4 different marketing groups. You say we call it a monopoly, but we have the ability to forecast what the production levels are going to be, supply is going to be, and sort of match that. I mean, how do you see that playing out, and how do you see as a smaller producer fitting in with that? Seamus, sorry if you don't mind, particularly for the.
Oh yeah, okay, Mark, no problem. So yeah, those tons that you were talking about, 63, 69, 71 million tons, they're MOP tons. So for us, we're SOP tons, and we're probably, our market's about 10% of the size of that. So we're around 7 million tons. And so it's different. So I'll talk about SOP because Achim's there, he can talk about MOP. But for us, the structure on the supply side is different. It's not controlled by any particular group. There's a range of small producers. Half of those, say, 7 million tons are actually made by the Mannheim method, which is the name of the method where you convert MOP into SOP. So it's a factory-based method. And so what typically happens structurally is it's very hard to find viable deposits that you can make SOP from. That's why the supply side is the way it is today, where half of it is MOP being converted. Now, those guys have a cost base which they can't control. So they buy MOP, they buy sulfuric acid, they pay for the energy, they cook it up, and they make it. And that holds up the supply side, the cost curve. What I see structurally happening for us is there's going to be more and more regulation on those guys because they're high energy, they're high pollution producers. The reason they exist is because of insufficient natural supply. Once Kaluli comes on and starts producing, it'll be a natural supplier. It'll be the very bottom of the cost curve. And our simple strategy is start it at the right level, the right scale. I mean, Achim talked about the various modeling that they've done. We did the same thing and worked out that our right size to start is about 470,000 tons. But from that point on, we grow it as fast as we can. Because from the way we look at it, there's 3.5 million tons, which is all of the Mannheim producers, which are primarily based in Europe and China. All of those guys necessarily have a much higher cost of production than we do. It's inevitable. And so we start with them. And we grow as fast as we can. We push our costs down. We're a natural product. There's all kinds of benefits and macro themes that we play into. So for us, it's very different to how the MOP side works. But I better pass to Achim to talk about how that MOP side works.
Yeah, I mean, I think you hit the nail on the head. Basically, I think you need to, you can only survive if you have a very low cost OPEX range. That's basically where you're making your profits with. I mean, we're going to be competing with major producers like Uralkali, Nutrien, etc. However, I mean, I'm very much convinced that with our configuration in the Republic of Congo, also along with low-cost abundant natural gas that we need for our evaporation process, we are very competitively priced. I mean, we all say we're at the lowest quartile cost curve. In fact, I strongly believe we are, because we have been developing our project in the Republic of Congo for many, many years. We know the ins and outs. And I think that's basically how you can survive and make a good profit margin over the coming years.
Yeah, I mean, we've done looking at the cost dynamics, because that underpins. I mean, we look at it from the bottom up in terms of what the cost dynamics are and how that's going to affect pricing. I mean, the average. Sorry, so we're talking about MOP, but the average delivered cost is $135 per ton. For the 90th percentile, it's $163 per ton. And if you look at all-in costs, we're looking at about $245 per ton. So we view that as being a flaw on the pricing, because the way the market works is we can turn supply off marginally, okay, but we view the 245 as a minimum pricing, and where we are now is a reflection of demand growth. We saw the pricing. You talked about the price in Brazil. Strong agricultural prices. As the agricultural prices rise, what we saw with harvest in Brazil is an increase in demand for fertilizers. Particularly, also we've got a weaker real, and that drove pricing up of potash across the board. So we think, our view as FDC is, 245 minimum for MOP. It's expected to be a lot higher over the sort of the medium term. I mean, this sort of feeds in now into sort of my next kind of big news, really, in terms of the supply side, has really been about BHP finally greenlighting the Jansen Stage 1. It's $5.7 billion to produce, 4.35 million tons. I mean, Achim, have you got a view on what does that say about the market?
Well, I think it's, again, very difficult to predict. I think there are a lot of voices that say with BHP coming on stream with the next few years, and I believe, or my view is that it's going to take until probably the end of, or until 2030, until a 4 million ton plant is going to be in production. It remains to be seen whether their forecasted OPEX costs are going to be realized. I don't see that particularly. I can only speak for myself and our company as a potential threat. I mean, they all look at BHP as a big player. Again, cost is everything. We will be able to produce in the $50-$60 range. I've looked at some public presentation from BHP. They're looking at something like $100 per ton FOB. I think they do also have a huge logistics challenge in front of them, getting their production from Saskatchewan to the West Coast. There's a lot of trains going to leave the station to make it to the port of export. So I believe, well, I of course wish them all the best of luck, but I don't think it's going to make a big difference. There's enough demand in the market for MOP to absorb additional capacities. And basically we will starting small, like we would probably start with 600,000 tons and then scale up, as also Seamus said. We have the ability to scale up very fast to larger capacities and then also be even more profitable.
I think, that's true. I mean, when I looked at BHP, it's going to be multiple years out now before it actually starts adding production into the supply side. By which time, we talked about the drivers: population growth, urbanization, reduced arable land, reduced biofuel. Means the demand is going to be there. But what it particularly speaks to me about is the fact that, for a long time, first new commodity BHP have got into, and we've taken, I've been at Fox-Davies for a year. I was in industry with fertilizer for 5 years. Before that, I was back in the city. And when I was an investor covering BHP, when we first announced this, it was all about capital deployment and return on investment. Mm-hmm. And now we've made a decision now to go ahead. I mean, that is an endorsement for the potash sector that BHP are committing that level of capex on the view that you got long term. These assets are big. I mean, your assets are big. You got multiple decades of production life there with good sustainable returns. And particularly as we look into a inflationary environment, particularly for food, it's only going to be positive for fertilizers. And if you're looking for a good investment, which inflation hedge, fertilizer, particularly potash, is a good bet. I mean, I don't know, Seamus, if you've got a view on my rant there.
No, Mark, I agree. I mean, I'd probably take a slightly different angle. I mean, it's absolutely positive for the sector that BHP is interested in it and that they've green lighted it. They've probably already spent close to $5 billion already. If you read their announcements, they're sort of nearly $5 billion into it. What I read was that they think they need to spend another $10 billion. But if I was a betting man, and I know that history doesn't repeat itself, but there's that saying about it sort of rhymes. I'd expect that there's almost no chance of BHP being on time, on budget, with a project of that scale. I just don't see it happening. And it's probably going to be the case. And again, I'm not crystal balling here. I'm just saying what happened in the past. They'll probably get a very, very high spec mine built right about the time that the next commodity, potash downturn happens, and they'll end up selling it to Nutrien at a discount. That would be my guess, simply based on history and the way these things rhyme. I hope I'm wrong, because I'm actually a BHP shareholder, but I think there's got to be full disclosure. But I think that's one of the possible outcomes. But I think overall, to see a company like that look at potash and say this is something for the future, they're not talking 5, 10, 20 years, they're talking 50, 100 years. I think that's right. I think it's a very good space. And the way I look at the potash market now, the MOP market, that is, it's kind of like the iron ore market was in some ways 20 years ago. And it's quite opaque. It's annual contracts. It's dominated by what price that China and India agree to. I mean, sooner or later, probably China will start to be unhappy with that cartel and their group, and they might start funding some of the smaller companies to try and get up and running during this higher priced environment. And the better ones will stay on and, live through the cycles. That's how I see it.
Yeah, I tend to agree with you as well. Yeah.
Go on, Achim.
Yeah, I think that was a good summary. I tend to agree with your views as well. Again, it's very difficult to have a clear crystal ball look ahead. But again, cost is the main driver, and I think if you look at iron ore and other commodities, in the end, you need a game-changing project with a very low cost base that is sustainable over many, many years, over life of mine, probably 25, 30 years. And that is also will attract the right investors to finance your project.
I mean, absolutely. I mean, you talked about iron ore back in the day. I mean, these are the assets that built those companies: Vale, Rio, BHP, and it's entirely possible that you guys in a few years' time will be in a similar position. Yeah. But I mean, it's not without challenges. I'm going to touch that now. There's been a few instances with companies having technical challenges in the junior sector. What particularly are the challenges you feel facing new potash developers, and maybe give some examples of stuff you faced or people have faced? I mean, Achim, do you want to start with that one?
Yeah, sure. Look, we have been developing our project since early 2017 with exploration, drilling, PFS, and to a fully fledged DFS, feasibility study, including regulatory approvals, etc. I think we've been talking to strategics and off-takers, marketing organization. I think to a certain degree, it's the challenges to bring across solution mining, which is not well known to many players. I think that is something that can be easily overcome because there are certain reference plans where this mining technology is being applied. The other point is probably a lack of certain knowledge of the Congolese jurisdiction, how to operate there. We have been there since '98. I've been personally working in the Congo since early '90s. And I think that is something that is a learning process, that's an educational process. And a part of that, I think it's, just attracting the right partners, long-term partnership to develop a first-class asset in the Republic of Congo. Yeah,
I mean, you're a private company at the moment. I mean, you've been supported. I mean, Airbed have been helped immensely. That you got strong financial back in there. I mean, Seamus, what sort of challenges do you think? I mean, what's been your biggest challenge being on Danakali?
Well, the two biggest challenges we've had are linked. The first challenge is getting people to understand the truth about Eritrea and what it really is as a mining jurisdiction. There's a lot of untruths and outright lies out there in the community, which are all, the lies and the untruths are all negative and calculated to make Eritrea a difficult place for people to deploy money to. And so that leads directly to the second challenge, which is our biggest overall challenge has been raising the counter-cyclical capital, if you like. The right time to invest in these long life assets, it's not when you're having a price spike and SOP's hitting $1,000 or, where we're heading now. The right time is 5 years ago when you appreciate that you need, and I know Achim's been through this too, and he's fortunate to have Airbed there. You need to raise the money and deploy the money. And, BHP is another great example here, right? If they're dead serious about potash, they should have been deploying this money 5 years ago when it looked like potash was going to be bumping along the bottom of the price, curve for a long time, because then they'd be 5 years advanced now and be ready to pick up value on the upside. That's why I said before, they're probably going to get into production with a fantastic mine right in the next downturn. It's okay for BHP. It's not okay for juniors. So for juniors, it's that getting that counter-cyclical capital. And I think everyone in the space knows, if you look at London, which previously was a really good funder of, mining projects, particularly in Africa, a lot of the most experienced guys and the best funds over there, AMED excluded, have left the space in the last few years. So there are now very, very few people, managing money in London who are looking at these, long life mining assets in Africa. Whereas if you were to go back 20 years, you could name 10 that were doing this all the time and had experience in it. So that's been the biggest challenge for us. But I think we're just about through that challenge. We had some great support on the way through, and I think we're at the point now where it's going to be resolved very quickly.
I mean, that's good. I mean, we are in quite pretty exciting times, particularly for in the potash space. I mean,
yeah.
We've talked about in the majors, high capex, big projects. I mean, what are, on the flip side of the challenges, what are the opportunities as a smaller producer developer? I mean, Seamus, what do you see as the real sort of opportunities for you at Danakali?
Well, look, the greatest opportunity for us and the simplest opportunity for anyone to understand is, if our asset was not in Eritrea, it would absolutely be in the hands of BHP or Nutrien or one of the major producers. It's that caliber of asset. When these major companies talk about, sorry?
I signed this off as well. I agree 100% for projects.
So when you've got these tier one assets, I mean, as a junior, and it's really interesting. I just read today a story, and I don't want to keep mentioning BHP, but it was about BHP. And again, they've just decided apparently that now, for nickel and copper, they're prepared to drop their previous, we only go to tier one jurisdictions looking for tier one assets attitude. Because, funnily enough, most of the tier one jurisdictions are pretty well explored. And most of the tier one assets in those tier one jurisdictions are pretty well known. So you need to go to other jurisdictions. And I think, the way people look at risk, it's one of my favorite topics. But I think for us, it's really encouraging that BHP is starting to take the attitude of, if the deposit is good enough, all of those other soft risks don't really matter. It's about having a good enough deposit. And, that's for us. We've got a good enough deposit. We've got what I genuinely believe to be the best SOP deposit in the world, with no exceptions. And I challenge anybody to come along and tell me why their deposit's better. And you can start with, have they got a better grade? No. Have they got a better geometry? No. Have they got a better geology? No. Have they got a better, geographic location? No. Have they got better growth potential? No. So you do those 5 things across any mining asset, and if you can answer no, 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 you've probably got the best. And that's the opportunity for us.
Yeah. Achim?
Yeah, I think this is quite summarized. I think we also, like for MOP, I strongly believe this. We got the best deposit ever. It's not only about geology. For me, it's geography and of course infrastructure. We're right at the coast. We got the thickest seams drilled ever, probably worldwide. I think this is one of its kind with 210 meters of mineable thickness. There's abundant gas in the Republic of Congo. We got the logistics advantage right across to Brazil. And I would be more than happy to see a project of this caliber being implemented, maybe first of its kind. Maybe, I don't know how fast Danakali is going to have to see that first of its kind going ahead in the Republic of Congo or in Africa. I mean, there has been a potash operation in the Republic of Congo in the late 70s. Was a conventional mine that produced something like 400,000 tons, and I would be very happy to see another potash operation being on stream on time and budget in Africa. And I wish the same also, of course, for Danakali.
Yeah, likewise.
I think one of the other advantages you have as a genius, as well as a smaller developer, is that okay, you can go to these jurisdictions. You haven't got the baggage of being a major, but you can also right-size the project. You don't have to deploy a large amount of capex to get a massive project up and running and trying to work out so you can right-size your project. As you talked about, Seamus, you've been doing that at Danakali. I know with institution, you can just add extra wells to increase your production, add some well as the market grows. It's what we were doing in Brazil as well. You start small and you build up as the market goes. So you don't have the baggage perhaps of having to deploy that level of capex.
No. Yep. Mark, we looked at a $2 billion project at the outset of the PFS that we started in 2017, like showing the highest NPV outcome. And I mean, this is, in my mind, not financeable. I mean, we had long discussion with our shareholders, Airbed Funds and Salmon Mining. And we all came to the conclusion in these kinds of jurisdictions, we rather start small with a, let's say, $500 million footprint, low cost OPEX. It's granted with all different kinds of modular. And then we basically build this, debottleneck, operate, and then basically ramp up to higher production scenarios. And I think that's the way to go.
Yeah, absolutely. And I think, if BHP are rumored to be looking at going into the DRC for copper, Republic of Congo, Eritrea, particularly when you've got the quality of the assets you can find, the assets you guys have got, it makes sense. Obviously you're bullish on the space. Population growth is more, 9.6 billion by 2064. You've got rapid urbanization. You've got increased demand for food. You've got all the inflationary pressures we've got. You can't see how potash into the pricing and demand is going to go away. That's why we've got, as I said before, we've got a floor pipe. And we expect these prices to stay for at least levels that need restocking. So I'd just like to thank you both for taking the time to join us. I mean, you both you've got slightly different products, slightly different minds. I just wanted to get a different perspective, particularly from my own. I just like to thank you both.
Thanks very much, Mark. It's been a pleasure.
Yeah, thank you very much, Mark. Pleasure as well. And thanks for this opportunity to speak to you and also, of course, to Seamus.